Hi, everyone, and join me in welcoming Prateek Jain to the Capitalmind Podcast. Prateek has joined us as a head of fixed income in the Capitalmind Mutual Fund, and today he's going to talk about one of his passions, liquid mutual funds. So, he's going to talk about liquid funds, which is a product he's going to launch soon, and we're going to dive into it, why you should care, why it stands up against fixed deposits, and where it stands versus the other funds in the debt mutual fund space. So, let's listen in and see what he has to share. Hi, Prateek. Welcome to the podcast. Why should I consider liquid funds anymore? There was a time many years ago. In fact, there's this famous video that Deepak and Vashish made many years ago where they showed that if you invested in, I think back then it was either a liquid fund or an ultra short term fund, then over some years, how much money you would save in taxes over fixed deposits at kind of the same rate. And it was both counterintuitive. You needed the Excel to understand it, and quite illuminating. And I think a lot of money moved into this space anyway over the years. But now the taxation for all of these is the same. I think the technology has evolved even on things like fixed deposits. You can go to some online marketplaces, shop around for the best fixed deposit, write tenure, do it completely online without kind of opening a bank account. And the rates are all essentially the same. So in this world where fixed deposits have upped their game, become tech savvy themselves, and kind of are at the same interest rates, what purpose does liquid funds serve anymore? Why should I care about them?
So in today's day and time, liquid funds are still relevant. Okay. One of the things is if you go and see the category, debt as a category, liquid funds still are 1/3 of the category, closer to 5 lakh crores
In liquid funds?
in liquid fund
Okay.
itself. The taxation angle has actually hurt the liquid fund category, but the increment flows have gone to some arbitrage and FOF kind of categories. So if you try to understand liquid fund, so liquid fund was designed for very short-term investments. So ideally in liquid fund, a fund manager can't buy any paper or any security which is more than 91 days of maturity. So ideally the volatility of the fund is very less. Second is the part wherein for a liquid fund, the fund managers are generally buying high rated credits, so you don't have credit risk over there. And another thing is, even after 5 lakh crores of management, liquid fund are giving you very good returns. So liquid fund returns are very close to 5.5%, okay, which is the current repo rate. And generally, we have traditionally seen liquid funds are giving returns very close to 5.5%. And in today's context, why they are relevant? Because if you go and do a short-term deposit in a bank, so most of the time, the bank deposit would be around about 3 to 4%. If you're doing a very short-term deposit, by short-term I mean 2 months, 3 months, 5 months, 6 months. So generally, the good rate of interest starts 1 year onwards. So if you're a corporate or if you are an investor who just wants to park their money for 14 days, a month, or something, liquid fund is a very relevant product. Also, liquid fund will have a gated exit loan after 7 days. So traditionally, it is designed for a person who wants to come in and invest for a week or more. And even FDs start from 7 days maturity and they go up to whatever 10 years. So liquid fund will give you a very good return, which is close to a repo rate. Okay. One thing is the liquid fund returns are continuous. When I say continuous, for example, if you do a deposit of 3 months, after 2 months, you go to a bank and you say you want to withdraw the deposit. Of course, you can withdraw the deposit, but you will have something called the prepayment penalty charges and all that. And eventually, you'll end up returns which are very close to like 1 or 2%. But for liquid funds, for that 2 months, the returns are going to be very close to the repo rate, which currently stands at 5.5%.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Past performance may or may not be sustained in future and is not a guarantee of any future returns.